Hello everyone, my name is Vishakha Nilkhe and welcome to my YouTube channel. In this video, we will study about ratio analysis. That is, what does the ratio analysis means, why it is used, what are the advantages of using it, what are the stages involved in it, and the classification of the ratios. So first, what is ratio analysis? Ratio analysis means it is the technique of analyzing financial statements. Means the organization has to analyze its financial statements, for which there are various tools and techniques, in which ratio analysis is also one of the tool and technique, in which company can analyze it in more proper manner, and it finds out the quantitative relationship between the different financial figures in the financial statement. Why ratio analysis is used? So ratio analysis is used to understand the risk that company has, and it compares the current performance of the company with their previous record, and it helps to compare the performance of their firm with their similar competitors. Where does the information for ratio analysis comes from? So first, it comes from the income statement and the balance sheet. Stages involved in ratio analysis. The first is gathering data. The organization gathers data, then calculates ratio, then interprets the result, and last stage is of taking actions. These are the advantages of ratio analysis. The first one is that it provides the significant information to the users of account, that is internal and external users. Then it helps in comparing two or more firms, and it also helps in determining both the liquidity and long-term solvency of the firm. These are the classifications of ratio. First is liquidity ratio, second is activity ratio, third is profitability ratio, and fourth is solvency ratio. First, the liquidity ratio. The liquidity ratios are the ratios which are useful in measuring the firm's ability to meet its current obligations, that is short-term liabilities. Liquidity ratios includes the following. First, the current ratio, second acid test ratio, which is also called as quick ratios, and the third is absolute liquid ratio. The first one is current ratio. Current ratio is calculated to establish the relationship between the current assets and current liabilities. So the current ratio is calculated by using the following formula, that is the current assets upon current liabilities. Second is the acid test ratio or quick ratio. This ratio is the best measure of liquidity in the company. 1:1 is treated as an ideal ratio. The quick ratio can be calculated by the formula liquid assets upon current liabilities. The third one is absolute liquid ratio. This ratio measures total liquidity available in the company. This ratio only considers marketable securities and cash available to the company. The absolute liquid ratio is calculated by absolute liquid assets divided by current liabilities. Then the next is activity ratio. The activity ratios are those ratios which are calculated to measure the operational efficiency of a business, which includes first the inventory turnover ratio, second the debtor turnover ratio, third creditors turnover ratio, fourth working capital turnover ratio, and fifth fixed asset turnover ratio. The inventory turnover ratio. The inventory or stock turnover ratio indicates the velocity of the movement of goods during the year, and it is calculated by the following formula, that is cost of goods sold divided by average inventory. Second is the debtors turnover or receivables turnover ratio. Debtors turnover is used to measure how effective a company is extending credit as well as collecting debts. The debtors turnover ratio is calculated by net annual credit sales divided by average trade debtors. The next is creditors or payable turnover ratio. Creditors turnover ratio is calculated to analyze the speed with which the payments are made to the creditors, and it is calculated by the formula annual credit purchase divided by average trade creditors. The next is working capital turnover ratio. This ratio is calculated to study the efficiency in which the working capital is utilized in the business, and it is calculated by the formula cost of goods sold divided by average working capital. Fixed asset turnover ratio. This ratio is calculated to measure the adequacy or otherwise of investment in fixed asset, and it is calculated by the following formula, that is cost of goods sold or sales divided by net fixed asset. The next ratio is profitability ratio. The profitability ratio is used to assess a business ability to generate earnings relative to its revenue, operating cost, balance sheet assets, or shareholders' equity over time using data from a specific point in a time, which includes first the gross profit ratio. Gross profit ratio is calculated by gross profit upon net sales into 100. And the second is operating ratio. Operating ratio is calculated by operating cost upon net sales into 100. The third is operating profit ratio. Operating profit ratio is equal to operating profit upon sales into 100. Fourth, net profit ratio. Net profit ratio is equal to net profit divided by net sales into 100. Fifth, net return on investment. Return on investment is equal to net profit after tax divided by shareholders fund into 100. Sixth is return on equity capital. So return on equity capital is calculated by net profit after tax minus preference dividend divided by paid up equity shares capital into 100. Seventh is earning per share. It is calculated by net profit after tax minus preference dividend divided by number of equity shares. Eighth is dividend payout ratio, and it is calculated by dividend per share divided by earning per share. Ninth is dividend yield ratio. So dividend yield ratio is equal to dividend per share divided by market value per share. 10th is price earning ratio. Price earning ratio is equal to market price per share divided by earning per share. The last ratio is solvency ratio. Solvency ratios are those ratios calculated to determine the firm's ability to meet its long-term obligations, in which there are four types of ratios, that is first debt to equity ratio, proprietary ratio, interest coverage ratio, and capital gearing ratio. Thank you for watching this video.